What is up, everybody? Mike the CPA here, and Chipper.
Affirmative.
Today, we're talking about bonds.
I admire your luck, Mr.
Bond. James Bond.
No, Chipper, not those kind of bonds. Oh! The bond funds we're talking about are actually the 4 Vanguard Long-Term ETF bond funds that are available for you and I as investors to invest in that are located on the Vanguard website. This is actually a subscriber requested topic, so thank you so much, subscribers, for requesting it. I hope you join me on screen as we head over to view a spreadsheet I've put together for you guys. The spreadsheet, I've loaded it with a ton of research and data for you guys to analyze. It's completely free to download, so make sure that you take a moment, go down to the description section of this video and download the spreadsheet for yourself. We're going to be talking about, in this video, the performance of these long-term Vanguard ETF bond funds. We're going to look at the yield, how often they pay interest or dividends. We're also going to talk about some of the pros and cons and also the risks associated with when you invest in bonds. Remember, guys, if you liked the video, make sure to let me know by hitting that like button down below. If you're brand new here, be sure to subscribe for our weekly videos. Every single week on Money and Life TV, we teach finances, investing, and taxes to help people like yourself become fiscally fit. Let's get it. Let's kick this off with the EDV, which is the Extended Duration Treasury ETF. Now, I personally own this one. It has a yield of about 3%, which it pays on a quarterly basis. Just so you guys know, let me zoom in here. Data research on this is about July 10th of 2018. That's going to be the data research on all these bond funds. On every single one of these Excel work tabs that you're going to see, guys, I have a link that will take you directly to the Vanguard website where you can learn about this bond fund. It has a pretty high beta of 4.5%, and that's because bond funds typically have a movement pattern that is inverse of the stock market. So if the stock market goes up, bond markets will usually stay steady or might go down. Inversely, if the stock market goes down, bond funds will hold steady or may go up in value. So it usually moves inversely compared to the stock market, and we're going to see that here in just a second. So that's why the beta is pretty high. Year-to-date return on all of these bond funds is going to pretty much be down, guys, okay? So we're down about 4%. It's been in existence for about 11 years now, and these bond ETFs, if you're not familiar with bonds and how the ETFs work, it works just like any other kind of ETF, really, where you're buying in at a certain price, and you can buy or sell this ETF anytime you want. So it's going to be just like a stock. Currently, market price, as you guys can see here, is about 115 bucks, and the net asset value of the underlying assets is 114, which means all these bond funds we're looking at today here are trading at a premium versus a discount. And you guys I have links at the back end of this document that you guys can check out to learn more about bonds at your own time. Let's move down the ladder here. This particular bond fund has U.S. Treasury bonds. In fact, 100% of the bonds are governmental U.S. Treasury, AAA rated. When I say AAA, I mean they're highly secure. The chance of these defaulting are extremely low. These are AAA rated government bonds, or at least I believe all of them are, if not most of them. Average maturity of the bonds in this fund, if you look down here, is anywhere from 24 to 25 years. And there's 80 bonds in total in this fund, and about 1.8 billion in government debt assets. And I can tell you guys from experience that the yield, the dividend, it's going to come in the form of an ordinary dividend. You're not going to get qualified dividend treatment on this, okay? So you're going to have to pay taxes at the ordinary dividend income rate. Let's talk about the average annual returns. Nothing stellar, but so for 1 year, it's only gone up 0.5%. Over 3 years, it's gone up about 5.5% on average. 10 years, about 8%. So most people, when they're investing in bonds, they're really not investing for performance, but you might get a little additional performance in the underlying investment itself, which if you do, consider it a bonus. But most people who invest in bonds are looking to hedge their market risk or to actually just have some sort of fixed stream of income. As you guys scroll down to the bottom of this first workbook, you can see that 100% of the assets are held by the Treasury or Treasury agencies, and it's 100% U.S. government debt. I thought it would be helpful if you guys actually see how these things move relative to the S&P 500. So what I've done is I've put EDV here in gray, and I've mapped it out against the S&P 500 for over 11 years. And the blue line is the S&P 500. This is EDV. And if you study the graph, you will see that usually it moves inversely. So see this large spike right here? This is when the market crashed back in 2007, 2008. this bond fund, EDV, actually went up in value. So if you would have been holding this bond fund at the time of the crash, you would have made off pretty well because the market would have tanked, but you would be ahead. Because see how far the market went down here, but your bond fund values would be way up. So really, bonds are a way to hedge your risk when investing. If you guys want to know what Treasury strips are, I've put this little clip that you can read, and you can read the product summary up above, but I'll let you guys read all that information at your own time. Now we're looking at BLV, which is the long-term bond fund ETF. And as you guys can see, it's a slightly smaller beta of 2.5%. So it's a little bit less volatile than EDV. It pays monthly. So if you guys are looking for a monthly stream of income, this is your guy. It's going to pay about almost 4% currently on the yield. Year-to-date return, it's down about 5%. All of these, like I said, are going to be down. Years in existence, have been around for about 11 years. Risk meter, it's in the middle. It's not the highest risk and it's not the lowest risk. Currently, the price of this bond fund is about $89 a share. I'll let you guys read this product summary in your own time, but you can pause the video or feel free to read it when you download the spreadsheet. Average returns for 1 year, we're down about 1% if you held on to this. 3 years is about 4%. 5-year average annual return is about 5%. Since inception, average annual return is about 6%. So nothing stellar. So don't expect to get stellar performance other than the fact that you're getting the monthly or quarterly yield on these things. Unlike EDV, BLV has a variety of different bonds that it holds. So some of them are in U.S. government. When you guys see that these are the higher rated bonds, which means that you're more likely to get paid back if it's AAA or AA, but the lower that rating goes, the less likely you are to get paid if something were to happen. These are long-term bonds, guys, so the average maturity is around 24 years, and it holds about $10 billion in assets, which is quite a hefty sum. This is the bond distribution or holdings of this bond fund. A little bit in finance, a little bit in foreign, about 35% industrial, a little bit in utilities, but almost half in government bonds. So that's what this holds. Let's look at the graph real quick. Very similar performance to EDV, but I'll show you at the end of this video. You guys can, there's a tab called the comparison tab down here where you guys can view all the information on one chart. But in general, guys, once again, it moves inversely or on a steady pace relative to the S&P 500. The S&P 500 is in the blue. Some of the holdings, this thing owns over 2,000 bonds, and you guys can see they're mainly, this is just the first page. I mean, you would have to scroll and scroll to see all the holdings, but mainly U.S. Treasury notes and bonds is what it holds. VCLT, this is where I think it gets a little bit more interesting because now we're talking about corporate bond funds. So these are, the issuers are large corporations, as you guys will see here in a little bit. Risk potentials right around 3. Current ETF price of this is about 88 bucks a share. So this one is about 2% down for the year. But, you guys are going to see that the performance on most of these is just about the same. So I'm not really going to cover the performance too much. Well, but let's talk about what they own. So about half the portfolio doesn't have very highly rated bonds. So there is a little bit more risk associated with this. But let's look back at the yield up top here. You're going to get a nice yield, and it pays monthly. So you're almost getting 5% yield on a monthly basis on this guy, which is pretty nice. So 5% almost on a monthly basis. I like that. Beta is about 2.19. Remember, guys, the lower the beta, the less volatile it is. Year-to-date return, though, is getting hammered. It's down about 7%. Ouch. Looking at the chart real quick, guys, this thing's been around for 9 years. Notice it has a steady up and down movement. So even though you're not getting the stellar performance of the S&P 500, you're still staying steady with your fixed income streams, which is pretty nice. So what corporate bonds does it hold? Well, the main one is Anheuser-Busch. You have General Electric, you have CVS, Goldman Sachs, you have more Anheuser-Busch, Verizon Communications, Medtronic, Apple, Microsoft. This thing holds some big name corporate bonds, no doubt. Okay, guys, I've saved the most interesting for last, and that is VTEB, and that's Tax Exempt Bond Fund ETF. So this is tax exempt. You're going to see a bunch of holdings from different state agencies of bonds that it holds. And remember, the yield on this is very low. However, you have to realize, though, guys, is that about 2.5%, it pays monthly. You're like, 2.5%, Mike? That's nothing. Even though the yield is not as high as some of the other ones we looked at, remember, the income you're going to get is completely tax-free. Every other one of these we've looked at is taxable. Well, so when you receive the dividend payment, it's taxable, whereas this one that is not. So just remember that. So this is really advantageous for somebody in a high tax bracket. This one's only been around for 3 years. So I don't think the performance is even worth talking about, because you're really investing in the tax-exempt yield for that purpose, right? Most people are. Beta is near zero, so this is very low risk on these things. Let's go down the line here, and this is currently at about $51 a share. Hardly any movement in the last 3 years in terms of the underlying price performance of this investment. And this has quite a mix. So most of these bonds that it holds are highly rated, okay? So you're going to have, I think you're going to, overall, the portfolio holdings are less risky than, let's say, VCLT or BLV. This is the chart, guys. Remember, it's only been around for 3 years, but it doesn't really move much. It just lies dormant, but does pay a nice 2.5%, maybe even a 3.5% yield once you factor in the tax savings. In terms of the bond maturity on VTEB, about 50% of the bonds it holds has a maturity of 10 years or greater, with also shorter holdings as well. So it's nice to have a blended approach here, so I like that they have it, honestly. It has 4,000 something holdings in total. As you guys can see, New Jersey Transit, or New York State, Georgia, New York, Illinois. So all these bonds are going to be primarily of different states throughout the US, or different transportation agencies that are state related, but that is what gives it its tax exempt status. These bond funds are relatively similar other than the types of bonds it holds. So remember, EDV holds treasuries of the US government. BLV owns a mix of treasuries with some finance and some industrials. VCLT holds long-term corporate bonds, so Anheuser-Busch, Medtronic, Verizon, Apple, Microsoft, you name it. It has all those different companies' bonds and has the highest yield of all of these. Remember, VTEB, you're going to get it's a lower yield, but you're going to get the tax-exempt status. It's a quick comparison, guys, and I'm not going to go over this with you because I think some other stuff is more important to talk about. But on this comparison tabs, you can see the performance of how these things do relative to each other, the beta, the yield, the year-to-date performance, 10-year performance, and you guys can see on this chart, the black line is the S&P 500, and I've ran it for you guys for various time periods. And you guys can see the color coding for each type of bond fund that we've talked about in this video and how it compares relative to the rest. Now let's cover some things that I think are important for you guys to know as investors when it comes to bonds. Okay guys, at the back of this spreadsheet, I've included some extras for you that I don't normally do. This are several links to different articles so you can brush up, fancy up on your bond knowledge so that when you go to the dinner table, you're gonna sound like a bond boss. So let's just take real quickly some of the advantages of bonds, the risk of bonds, and stuff like that. Just real quickly, most of this you guys can read in your own time. But really, there's several reasons one might consider investing in bonds. Of course, the first one is diversification. If we have all of our holdings in stocks, we're going to be subject to a lot of risks. You know, I don't own a lot in bonds personally because I think because the interest rates are rising, I'm kind of skeptical about them. But there's still some benefits to bonds as well. But you can also, there's a steady stream of income depending on the type of yield you're going to get on these bonds. Liquidity, they're easy to sell, especially in the form of an ETF like these Vanguard ETFs for bonds we've been talking about. There's legal protections, there's tax benefits, especially for the tax-exempt bonds. Remember guys, bonds provide a nice safe haven for your money, and they often move inversely to the market. So if the market's crashing, bonds will usually hold steady and give your portfolio a little bit more balance, a little bit more oomph when the market's not doing so well. Often bond yields are better than the bank. Now these are long-term bond funds, right? But there's short-term bond funds as well. If you're really young guys, if you're in your 20s, 30s, then I would recommend you hardly put any money in bonds. You can maybe put a little bit. I wouldn't put more than 20% of your portfolio. That's just my opinion in bonds. I would be more focused on growth and other dividend paying investments. But you guys can do what you want as you learn more about these. Of my portfolio, you know, right now I only own about 5% in bond holdings. The other 95% is pure dividend paying stocks and growth stocks. I'm not saying do what I do, but that is what I do. I think one of the biggest risks with bonds right now is that you have to remember is that for the past 30, 40 years, interest rates, the trajectory of interest rates have been going down. Well, now interest rates have bottomed out. As you guys can see, the Fed is slowly starting to bring them back up. And that usually hurts bonds, especially long-term bondholders. So you can get short-term bonds as well. So one of the strategies to kind of mitigate this interest rate rise risk is it's this concept known as laddering, which means you will buy bonds with different maturities. So if you guys remember, EDV, when we were looking at that, had bonds that matured after like 25 years. Well, you might also want to invest in some shorter term bonds that mature within 3 months, a couple years. So basically with shorter maturity dates. So you'll have some bonds with longer maturity periods and others with shorter to kind of mitigate this interest rate risk, because really when interest rates rise, it hurts the long-term bonds the most, not the shorter ones. The short ones can adjust to the new interest rates quicker. I'll let you guys read this article, read through these different risks. That's why it is very important and crucial to do your homework, guys, on all this stuff before you invest in bonds. Learn what you're investing in. Always learn what you're investing in, and you guys can do that right here. A couple other risks on bonds: interest rate hikes, inflation risks. So if the bond yield is not keeping up with the current price of inflation, your money will lose its value over time. Market risk: if the bond market crashes, well, bonds are in the bond market, so there's not too much you can do about that. And there's also credit risk. So don't always be fooled by the yields, because typically the higher the yield, the lower the bond rating, the more risk for default. So just remember that when you're investing in bonds, sometimes the highest yield isn't the best option. So you might want to buy. So if you want to invest in corporate bonds per se, like that Vanguard corporate bond ETF we're looking at, VCLT, you might not, if you want to invest in bonds, you might put some of your money here to get some of the higher yield, but you also might invest some in another bond fund as well, like ETFs, so you can spread out your risk, because the corporate bond funds many of their bonds have lower credit ratings. As you guys can see here, about 80% of their holdings are not AAA, because AAA is the best rating. Well, over half their holdings are A or below A holdings. Keep that in mind when you're going to invest in bonds. Don't always focus on the yield. Think about the maturity dates, or think about the maturity period. Think about the tax status of the bonds, if you want to invest in tax-exempt bonds or something else. Think about if they're in treasuries, if they're in companies. So these are all some of the things to consider when looking at bonds. Hope you guys found that helpful, guys. That's pretty much all the information I have for you today. I had a lot of fun learning about these different bond funds. I think that they can definitely be a valuable tool in your portfolio if you use it correctly. And thank you so much, subscribers, for requesting this topic. It was a lot of fun to make this video. With that being said, guys, if you have not already subscribed to the channel, make sure you do so by hitting that red subscribe button down below. Share this information with a friend, especially somebody who you know wants some bonds in their portfolio, because I'm sure they would be happy to learn about all these different ones that are offered by Vanguard. If you want to see more stuff like this, just let me know down in that comment section down below. I'd love to hear from you guys. So whether you leave a comment about this video or something else, just to say hi. All right, guys. Well, thank you for your time hanging out with me once again here on YouTube on Money and Life TV. Until next time, you take this information, download this spreadsheet, and use it to live your life uncaged. Bye, guys. Peace.
Well, he's certainly left with his tail between his legs.